Alright, welcome back on the seventh part. We were discussing about the average tax rate. How do you compute the average tax rate here? The average tax rate is actually the total tax that you have computed here, the total of all this, okay, total divided by the 4 million, 4 million taxable income. You get the average tax rate to be 34%. Now that is the average tax rate. And what is the marginal tax rate? The marginal tax rate is actually, remember the definition for marginal tax rate? The tax rate that will apply if you earn $1 extra taxable income. So right now the income for the company is 4 million. If it earns $1 more, this $1 will be taxed where? At 15%? 25%, 34%, 39%, or 34%. Note this, 4 million and $1 will still be in this range. Okay, it will be still less than 10 million. Therefore, this is the tax rate that applies. That is 34%. So the marginal tax rate is also 34%. But here it happens to be the same. Okay, but the tax rate, the average tax rate and the marginal tax rate is not likely to be the same, but in this case it just happens to be the same. Okay, so that is the difference between marginal tax rate and average tax rate. The average tax rate will be based on the total tax divided by the total tax paid, or incurred or payable by the company divided by the taxable income of the company or business. Now the marginal tax rate will be the tax that will be applied on the next dollar, the additional dollar of income, taxable income, or the additional ringgit of taxable income of the firm. Okay, in this case it is 34%. Is that clear? Right. If you have any questions, please go to the comment and then leave a comment. If you have a question, then I will try and address. I'll respond to those comments. Alright, with that we finish this particular key point. Let's go back to the slides. Okay, we can shift this slightly back to the original position here. Alright, now we have finished this and then we come to the second part of the question. We have addressed the second part of the question anyway, but we will go through this. If you are considering a project that will increase the firm's taxable income by 1 million, okay, what tax rate should you use in your analysis? Okay, you would still use the marginal tax rate, not the average tax rate. The marginal tax rate is still 34%. Why? Because 1 million, okay, plus this 4 million, meaning your taxable income will be 5 million. So on this $1 million income, additional income, you will pay marginal tax, not the average tax. Even though the average tax and the marginal tax in this particular example is the same, but here 34% of this 1 million will be paid as taxes. Therefore 34%, the marginal tax rate is relevant. Okay, when you compare the two, which is more relevant for finance? Average tax rate has record purposes. You just record for record purposes. It has no implication for decision making. But marginal tax rate is has implication for decision making. Your decision will change the marginal tax rate, or the marginal tax rate may change your decision. So it has feedback. So here marginal tax rate is very important for financial management decisions. Okay, so if your marginal tax rate is higher, okay, then if you are going to earn a larger amount of income, then you will pay a larger amount of tax from that taxable income. Therefore, average tax rate has very little implication for financial management decision. So marginal tax rate is more important. Is that clear? Alright, let's move on to the next and final key point or key concept in this chapter, which is deriving the cash flow statement equation. Okay, so this is a rather long part, yeah, the final part is rather long. First, we will try deriving. Yeah? The deriving of the equation is not so important. The application is more important. But I think in the interest of understanding, yeah, the equation, so I will show you how this equation is derived. Yeah? But students do not need to worry. Okay, what they need to do is actually apply the equation. Yeah? But I think it will be better if the students understand how this equation is derived. Yeah? Therefore, I'm going to show how this equation is derived, yeah? From very basic, yeah? From the very first step, and then I'll go step by step, yeah? In order to explain how this equation is derived. Yeah? First, you have this equation. This is called the balance sheet identity. A stands for asset equals to liabilities plus equity. Yeah? L stands for liability and E for equity. So that's the first equation, and this is assets must be equal to liabilities plus equity. This is the balance sheet identity that we have seen in the beginning part of this chapter. Okay, now, yeah, we can divide each of these items into smaller items. Yeah, that means we can break assets into two parts, liabilities into two parts, and equity also into two parts. Yeah, first, assets. Yeah, assets will be equal to CA plus NFA. Yeah? CA stands for current assets. NFA stands for net fixed assets. Yeah? So you have current assets, fixed assets. Yeah? We use net fixed assets because there will be depreciation, yeah, from fixed assets. Therefore, we take net fixed assets. Yeah? Not gross, yeah, fixed assets. So we take net fixed assets. Liabilities likewise can be divided into two components. One is current liabilities, and you have long-term debt. Yeah, you don't say long-term liability, even though that's correct. Yeah, you can also say long-term liability, but the widely used term here is long-term debt. Yeah, here you can also use short-term debt, but current liability is not only short-term debt. Yeah, it also has other components. Therefore, we use current liabilities here. Okay, so these two will make up total liabilities or liability. Yeah, generally, then equity, yeah, can be divided into two components. One is common stock. When we say common stock, this includes, yeah, common stock and additional paid-in capital, or ordinary shares and share premium. Yeah, so this includes that. Yeah. Now the second component is CRE, or cumulative retained earnings. Yeah, so this is the retained earnings that you see in the balance sheet. Okay, so these are made up of two components. Is that okay? Now we can expand this equation 1 by considering, yeah, equation 2, 3 and 4. Yeah? So we replace 2 and 3 and 4 into equation 1. So assets changes to CA plus NFA from here. Liabilities changes to current liabilities plus long-term debt, which is here. Okay. Then equity changes to common stock plus cumulative retained earnings, which is here. Alright, so this equation 5 is basically equation 1, but considering, yeah, equation 2 to 3. Yeah, we replace this into this, then we get equation number 5. Okay, I hope that is clear. No issues there, I think. Okay, everyone should follow, yeah, until this point. Next, yeah, from 1. Okay, now what we have done, we have taken this. Okay, if this is true, this is the level of asset. It must be equal to the level of liabilities plus the level of equity. Yeah, this is the total amount. Yeah, but if this is true, then the change, you know, this triangle here, triangle symbol here, refers to delta or change in. Yeah, it is reflected as change in assets. If the level of assets must be equal to liabilities, level of liabilities plus level of equity, then the change in assets must be equal to the change in liabilities plus the change in equity. If this is true, this must be true. Yeah? So you need to see the logic behind this. Yeah? Note, yeah, in finance or accounting, everything that we, I wouldn't say everything, but almost everything, yeah, has a logical basis. Yeah. Nothing or very few things are arbitrary. Yeah. Okay, so you need to understand the logic, yeah, behind this so that you can appreciate, yeah, why something is given, yeah, or taken in that manner, okay, or said to be like this and so on, yeah. So it's important to understand the rationale, yeah, behind this. Okay, so if the level is equal, the change in the level must also be equal, yeah, because this is the level, okay, at this point. What was the level before this point must also be equal, right? Therefore, the change in the level must also be equal. Okay, the change in assets must be equal to the change in liabilities and the change in equity. Okay, so this must also be true. Yeah. All right. So if this is, yeah, if 1 can be translated into 5, okay, this, because of this, yeah, we reflect, we change 1 to 5. Therefore, 6, yeah, when we look at the change in the level of assets, so we can say change in current assets must plus the change in net fixed assets must be equal to the change in current liabilities plus the change in long-term debt plus the change in common stock plus the change in cumulative retained earnings. Is that okay? So we have not done anything remarkable, yeah. Okay, we have just followed a very systematic way, yeah, of developing this equation so far. Yeah, I hope that is quite clear. Okay, any questions? If you have any doubt, okay, you can indicate, yeah, where you have the doubt. Okay, you can leave a comment. Okay, and then I'll come and address. Yeah, I'll try and address your question, yeah, later on. Okay, let's continue. Right, but, yeah, now note this, yeah, the change in cumulative retained earnings is actually retained earnings, yeah. Remember, the CRE is the amount that you see in the balance sheet, yeah. But the retained earnings is the amount that you see in the income statement. Okay, yeah, before it was all balance sheet item values, yeah. But here we introduce the income statement value here, yeah. The change in cumulative retained earnings must be equal to the retained earnings for the year, okay, or addition to retained earnings. We call this addition to retained earnings, yeah. All right, so we replace that, and, okay, retained earnings must be equal to net income minus the dividend. This is the net income. We have seen this in the income statement, yeah. Retained earnings is actually net income minus the dividend. We go back to the simple net income that we saw in the previous slide. Okay, so we find that retained earnings in the income statement, yeah, is net income minus dividend. DIV stands for dividend, yeah. Alright, therefore we replace this, yeah, equation 8 and 9 into equation 7. Therefore we have change in current assets plus change in net fixed assets. This is the change in assets, okay, must be equal to the change in current liabilities plus the change in long-term debt, which is the change in liabilities here, plus the change in common stock, plus it should be change in cumulative retained earnings here, right? But we change this, okay, we replace this with retained earnings, and we replace retained earnings with net income minus dividend. Therefore we have this, okay. So basically we have changed this in equation 7 to these two, yeah, these two. So therefore this, yeah, replaces, yeah, that component in equation 7. Alright, then, okay, we know that net income is actually earnings before interest and tax minus interest minus tax, yeah. This is again from the income statement, yeah. How do you derive the net income? You go back to the income statement. You know that net income is EBIT, earnings before interest and tax, minus interest minus tax. Okay, so this is this equation. Now we can replace this, yeah, EBIT into this net income here. Yeah, you can put all this, yeah, these three elements here. You can expand this further. So we have this. Yeah, what we have done is we have changed net income with these three elements. Yeah, EBIT minus interest minus tax. Is that okay? So therefore we have this equation, yeah, equation number 12. Yeah. Now what we are going to do now is to rearrange. Yeah. But before rearranging, we